Hello, my name is Eddie Tofpick. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Chicago wheat, Chicago corn and Kansas City wheat. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production, or recognition of any of these patterns, levels, analysis, or any related items on these, my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that, Chicago wheat. One single pattern had been the cause of the rising prices seen here throughout July, a pattern I highlighted 3 weeks ago. It's a bright pink June and early July based diamond bottom pattern, and the move up easily reached its primary and harder to reach secondary topside targets. Once we closed outside this pattern, we had a strong gapping move higher through the green short medium moving average, currently 636.5, the 50% Fibonacci lines of the May 24 to May 25 move at 622.25, the March 24 to May 25 move at 651 even, plus the important 50% absolute Fibonacci line at 632 even. But we started to slow at the bright red neckline extension, currently at 710.5, of the small October to November 2020 head and shoulders top, plus the October 2013 high at 720.5, and finally halt at the March 2014 high at 725.25, though one could argue that it was the approach to either the connected highest trend line of March to date, which is currently 740.75, or the bright green upper tine, currently 746.5. And I would take either of these as being legitimate. The pullback lower last week set up a pretty impressive, if unusual, key reversal down, pushing below the 50% absolute Fibonacci line and stabilizing under it. To help in these subsequent moves, I said last week, and I quote, "Just in case the 50% absolute Fibonacci line does not hold up, I've drawn a new Fibonacci for the recent action with the 50% Fibonacci line at 651. That would be the one to watch, as it also fills in the gap left on the way up." Now, I have one more thing to say, and it is to deal with this rise as what is called a vertical run-up pattern. In such a move as we have seen, about 2 out of 10 times we see a further continuation higher, though not as swiftly. Most of the time, 8 out of 10 times, we see a retracement of some or all of the run-up. A rough medium is about half the move up is retraced, with about 2 out of 10 times seeing a full retracement. However, the retracement is usually short-lived. A rough guide is about a month or so. The only exception is those that have seen a further continuation move higher, where it becomes problematic. This is worth considering here in this situation, and also in the other grain markets as well. And that's the end of the quote. These comments still stand, but I would like to add one further observation, and it concerns the market's actions over mid to the end of July. You see we have formed a small, irregular head and shoulders top pattern, a dark blue neckline currently at 660 even. Today we have breached that dark blue neckline, but that is all the market's managed right now. It is not a break just yet, so I cannot give targets below, but I can offer some potentials for a further move lower. Thus, a primary potential will be down in the 625.25 zone, just above the 50% Fibonacci line of the May 24 to May 25 move at 622.25, with a secondary harder to reach potential down in the 591.75 zone, just under a lot of congestion between 592.25 to 594.75. The obstacles in the way are fairly obvious and fourfold. They are filling in the mid-July gap, the recent 50% Fibonacci line at 651.25, the green short medium moving average, and the mauve medium moving average. Chicago corn. The market from mid-May moved down in what was ultimately a bright red descending expanding wedge pattern until it reached a very, very substantial support, and that's the dark blue May 2020 to date uptrend. That's right, a 6-year-old uptrend that still works, currently at 506.75. At this uptrend, the market formed a pipe bottom and rallied, really rallied, gapping rallied, out of the descending expanding wedge pattern, easily reaching both the primary and secondary targets for this pattern, as well as through the three main moving averages: the gold long moving average, which is currently at 450 even, the green short medium moving average, currently at 447 3/4, and the mauve medium moving average, currently at 457 even. In addition to these, prices overcame the pink lower trend line, currently at 452 even, of the July 23 to January 24 descending triangle, and the 50% Fibonacci line for the whole of 2025 at 454 3/4. So all in all, overcoming some pretty heavy duty resistance between 447.5 to 454 3/4, shooting all the way up to the congestion we saw back in May from the double top Adam and Eve type between about 460 to 485, and over the purple neckline, currently 474 3/4 of this double top, but finally pausing at a wide but somewhat sparse overhead congestion band between 490.5 to 497.5, containing the April 25 high of 497.5. Last week I was not sure if this move up had been done yet, as last Friday's action was not a big key reversal down as we've seen in the international grain markets, but here it was a long-legged yet indecisive spinning top pattern, but one that could also be called a key reversal up, if only just, but still up. Apart from the earlier mentioned congestion overhead, what can I say is this market was topped by another specific new congestion, part of a new larger pattern. The market was capped by the bright green upper time, currently 491 3/4, of the bright green mid-August 2025 to late June 2026 bullish shift pitchfork. This is a flat but good pattern, and we have followed on lower from being capped late last week. Thus on the downside, as I said last week, and I quote, we have some resistances that are now supports, ones already mentioned plus three new ones, the bright green middle time and a new 50% Fibonacci line for the late June to July move up at 449 even. Quite a lot around the 449 area indeed, as we have a gap left over between 440 1/4 to 458 3/4, end of quote. In addition to these, I can add this week support from the gold long moving average, which is currently at say 450 even, and the green short medium moving average, currently at 447 3/4. I also had another piece to say about the actions last week when I said, and I'm afraid it is a long piece, and I quote, now I have one more thing to say, something I've said in the grain markets but also applies here in corn, and it's to deal with the rise as what is called a vertical run-up pattern. In such a move as we have seen, about 2 out of 10 times we see further continuation higher, though not as swiftly. Most of the time, 8 out of 10 times, we see a retracement of some or all of the run-up. A rough median is about half the move up is retraced, with about 2 out of 10 times seeing a full retracement. However, the retracement is usually short-lived, and the rough guide is about a month or so. The only exception is those that have seen a further continuation move higher, where it becomes problematic. This is worth considering here in this situation. End of quote. These comments still stand, but I would like to add one further observation this week, and it concerns the market's actions over mid to end of July. You see, elsewhere in the grains, prices have formed sometimes a small irregular head and shoulders top pattern. However, the pattern is not so clear here, and indeed, it could be argued that it does not exist. So I will not be setting it up on my daily chart here. I thought you should know. Kansas City wheat. Much like Chicago wheat, one single pattern has been the cause of the rising prices seen here throughout July. A pattern I highlighted a few weeks ago. A dark blue, late May to early July based diamond bottom pattern. The gapping move up seen mid-July easily reached its primary and hardest to reach secondary topside targets. Once we closed outside this pattern, we had a strong gapping move higher through the green short medium moving average, currently 678 1/4, the 50% Fibonacci line of the big 2011 to 2019 move at 691 1/4, plus the important 50% absolute Fibonacci line at 697 1/4. But we started to slow at the newly drawn dark blue upper time, currently at 789, of the mid-December 25 to late June 2026 bullish shift pitchfork. This isn't the only pitchfork that I've had drawn on this, as I've also drawn, or should have said finesse, the bright red bullish Andrews pitchfork for the same move. So far this bright red pitchfork has not been impactful, but it is there nevertheless, as it seems that both these, especially I think the bright red Andrews pitchfork, seem to be a more optimized fit. There was also congestion dating from July 2023 up at 787 even and 790 3/4. That eroded the bullish incentive enough to cause what we have today, an unusual if pretty impressive, very large key reversal down. Now the market late last week dropped down through some congestion, between about 760 even to 764.5, containing the May 24 high at 760 even. However, prices started to hesitate and slow its descent between just under 740 even to 748, the latter being the 2022 and June 2014 low. I added last week, and it's quite a long if valid piece, and I quote, "There are a number of supports to know what to look out for. Obviously, we have the bright red and dark blue middle tines, currently 733.5 and 708 1/4 respectively. Plus, just in case, I would also keep an eye on the pair of 50% Fibonacci lines mentioned earlier. Plus, the new June to July 26 50% Fibonacci line at 701 3/4, as well as the gap left on the way up, further down, between 768 3/4 to 790 even. Personally, I think just maybe, the bright red middle tines might show some interesting support, but we shall see, though the gap below is the one to watch. Now, I have one more thing to say, and it's to deal with this rise as what is called a vertical run-up pattern. In such a move as we have seen, about 2 out of 10 times we see a further continuation higher, though not as swiftly. Most of the time, 8 out of 10 times we see a retracement of some or all of the run-up. A rough medium is about half the move up is retraced, with about 2 out of 10 times seeing a full retracement. However, the retracement is usually short-lived. A rough guide is about a month or so. The only exception is those that have seen a further continuation move higher, where it becomes problematic. This is worth considering here in this situation and also in the other grain markets as well." End of quote. These comments still stand, but I would like to add one further observation, and it concerns the market's actions over mid to the end of July. You see, elsewhere in the grains, prices have formed sometimes a small, irregular head and shoulders top pattern. However, this pattern is not so clear here, and indeed could be argued it does not exist. So I will not be setting it up on my daily chart here. However, the obstacles on any further moves down are still fairly obvious. They are the dark blue middle tine, currently at 707.5, which is part of a wide congestion between about 707 1/4 down to 691 1/4, and that's containing the 50% absolute Fibonacci line and the 50% Fibonacci lines of the 2011-2019 move, and the very recent June to July move at 691 1/4 and 701 3/4. Then the July gap between 690 even down to 678 3/4. Then the green short medium moving average and the mauve medium moving average. That last one is at 666 1/4. Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpick and ADM Investor Services International Limited. And here comes the final important bit.